Good afternoon and welcome to the Winter 2018 Linneman Associates Capital Markets webinar presented by Linneman Associates and Evaluate Software, a product of real estate financial modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, producer of Evaluate Software. And we have a great program for you today. And we have Dr. Peter Linneman, founder of Linneman Associates. For those of you who do not know, Linneman Associates is a strategic and investment analysis advisory firm headquartered in Philadelphia. Today we're using the GoToWebinar platform, and I would like to address a couple of housekeeping items just to make sure everybody is acquainted and comfortable with the technology. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that's by design and will remain the case throughout the webinar. If you're attending by computer, please now take just a moment to familiarize yourself with the floating control panel box, which should be on the right-hand side of your screen. We will be showing the slides in the larger viewer window, which is on the left-hand side of the screen. If you would like to download the slides, you can find the handout section on the floating control panel and click on the file name and it will automatically download. You don't need to have the slides up on your end because we will be showing them. But naturally, you're welcome to keep them for future reference. We've reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but please do feel free to submit your questions at any time by clicking in the questions field of the control panel box, typing in the question, and make sure you click the send button. If at any point during the webinar you get disconnected, just reconnect the same way that you initially got signed in. And without any further ado, I'd like to introduce presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you.
Great. Thanks, Bruce. Lovely to be here. I thought you were going to say based in Philadelphia, home of the Super Bowl champion Philadelphia Eagles, but you must have said that and I didn't hear it. Let me start off. If we go to the first slide with a chart I always do showing actual versus trend, real GDP. And again, whenever I say real, all we're doing is talking about adjusting for inflation. And you can see in the blue that actual GDP has been on a run for a bit, almost 8 years now. It has been growing, it continues to grow. But versus long-term trend, and I've said this before, you can kind of use any long-term you want to, back to 1800, and the picture will generally look the same. The annual shortfall for the current 12 months is 3.2 trillion. Another way of saying it is that over the last decade, that gap amounts to about $18 trillion of GDP has been the shortfall. And if you look at it, our current GDP is about $18 trillion. Another way of saying it is the shortfall in our GDP over the last decade is equal to our GDP in this year. And it puts a rather stark face on the shortfall. GDP, go to the next chart, you'll see this debate about is a 3% real GDP growth rate realistic? And the newspapers are full of this kind of discussion. And the best data that's out there says from 1820 to 1900, GDP grew at about 4%. From 1890 to basically 1948, it grew at 3.7%. By the way, there were ups and downs during all of those periods, some big ups and some big downs during those periods, but over the entirety of the period, you had a 3.7% growth rate. From 49 to 2008, it was 3.4%. And in fact, even in the first 4 years of George W. Bush's term, it was 3% a year. So it's not like we haven't had 3%. The 8 Obama years, it was 1.5%. And in an odd way, what you realize is how silly the discussion is of can we grow at 3%. We've grown at 3% essentially for 210 years. And yes, there were ups, and yes, there were downs, and yes, it was supposedly a new paradigm, and it wasn't. But the point is, over that, we basically did 3%. And in fact, the reason it trails down from the 4.2 to the 3% really has to do with population growth gets smaller as you come through the years. Productivity growth is not so much different over the long term. And the outlier is not 3%, the outlier is 1.5%. And I'm gonna, if you go to the next chart, and those of you who've been listening to me over the last 30 years, 20 years, 10 years, and 5 years, you're not gonna hear anything surprising from me, and you know I've been saying these things. First, 2.2% productivity growth over a long period of time tends to be the norm. Now that means some are growing at 5, 10, and 15% productivity growth in a year, and others are having zero productivity growth. And when you add it all up, you come out around 2.2%. And then you have about 80 basis points population growth. Now that's today's number. If you had gone back 20 years ago, that would have been about 1.2%. So, and if you had gone back 70 years, it would have been about almost 2%. Hence the higher growth rates back in time. You say, okay, 80 basis points of population growth, 2.2% of productivity growth, that's the 3%. And the thing is, to get growth, you need a predictable, legal, and an honest regulatory environment, which the United States generally offers. We have unpredictability, and as you know, the period we went through at the end of the Bush years and through the Obama years were highly uncertain and unpredictable in terms of the regulatory environment, and a very large number of unique market interventions were done. You also need micro incentives. Forget macroeconomics. Just think about every little business, every worker. You need micro incentives to hire, to invest, to take risk, and to work. And that means entrepreneurship is encouraged, work is encouraged, people get to keep their money. And in fact, it's interesting, Harvard's Robert Barrow, who probably has the best models on these, the most honest models, finds that the new tax law should add about 110 basis points to growth on an annual basis. And the reason is that it reduces tax rates. It leaves more money in your pocket as an individual taxpayer, and you will decide how to use that money based on how it makes you happy, and that tends to spur growth. When you give the government that money, they tend to spend it based on political incentives and redistribution incentives. Now, there's nothing wrong with redistribution incentives, but they don't create growth. When you spend your money rather than government, it creates more growth. And when taxes are lower, people have a greater incentive to invest, they have a greater incentive to take risks, they have a greater incentive to work, and the economy grows more. It's important to understand that if 1% more growth occurs, you're talking about extra jobs. And when you talk about extra jobs, those jobs are not going to the rich. The rich already have jobs if they want them. Any incremental jobs that will be added as a result of these incentives will go to normal people and lower income people who are being left out of the opportunity set. Go to the next chart. A very quick overview of the new tax structure. It basically shifts priority a bit from redistribution to growth. Now, you can argue that's good or you can argue that's bad, but it is. And it's a focus on creating growth rather than creating more redistribution with the incremental dollars. By the way, I don't view it as a stimulus tax cut. I view it as a tax cut to make us more competitive international and to create a better growth environment, not to, quote, stimulate. It's not some type of stimulus exercise. It's a fundamental exercise. The new tax law is estimated to cut everyone's tax. It especially cuts corporate tax rates. If you go back 20 years ago, the U.S. was the lowest tax jurisdiction among major countries, and prior to this tax cut, we were the highest corporate tax country among the major countries because everybody lowered theirs. This puts us down about in the lowest third on a basis. Now, others are going to start reducing theirs as a result of us cutting ours and making it more competitive. By reducing our taxes, you make the U.S. a more attractive place to grow businesses, and that will spur growth. Barrow estimates that about 25% of the extra growth comes from the corporate tax cuts. When you look at the individual, it is true that the estimates show that the top 20% in terms of income are expected to receive about 65% of the benefits of lower taxes. But the thing to remember is the top 20% pays 95% of all taxes. If you pay 95% of all the taxes and you only get 60% of the cuts, your relative burden went up. And this is one more of the last 50 years. Both parties, under every president, any tax change, has systematically shifted more of the tax burden onto the higher income groups and reduces the tax on lower income groups. And this is one more step in that regard. The last thing to remember is if you pay no tax, you cannot benefit from a tax cut. So about 50%, 50% of American citizens pay no individual income tax. Therefore, the only way they benefit is greater credits, which achieved, and interestingly, the repeal of the healthcare mandate is very distributes a lot of money into lower income households, particularly young lower income households, and they benefit from part of it. So this is a bill everybody will benefit from, at least from an income point of view and from a growth point of view. You can make a separate argument about redistribution, but from a growth and income point of view, this is pretty unambiguous. Go to the next chart. Where are we at? Real median income in the U.S., pretty close to trend. It's growing. It's growing at about 2.5%, 2.25% in real terms. People are doing okay. Basically, not surprising, is that you have a job, this is a good economy. And most people are getting their income around the median from having jobs. Go to the next chart, you'll see consumer confidence. Consumer confidence took a big jump literally after the election in 2016. Everyone, including me, wondered if it would fade. It is not faded. It's not only not faded, it's grown. And we are in the early stages of high consumer confidence. That will eventually feed excess consumer behavior. To date, it has not, but it eventually will. The more confidence you get, the more willing you are to take on things that you maybe not really can afford, but you'll buy them, that'll spur the economy. So we're in the early phase of that, probably has 2 more years or more to run. This growth will now move up closer to 3% a year, and I'm going to come back to that in one moment. Go to the next. Small business optimism also boomed after the election, and it has also stayed high. And I think the reason it stayed high is the regulatory burden stopped growing. It didn't fall away, it stopped growing. And small businesses are hiring more, they're investing more, and I think the new tax bill will only encourage more of that. Go to the next, economic policy uncertainty index. You see the red is the average, and it has normalized after being high really through the end of the Bush administration and almost all of the Obama administration. And then again, prior to the election, got very high, not surprisingly. Right now, it's right around average. Uncertainty about policies and the rules of the game are the enemy of growth. And I think that, again, you may not like the fact there's fewer regulations, but fewer regulations will fuel growth. And they'll fuel growth because when you get more regulations and more uncertainty, there's more lobbying and there's more compliance, less investing. And lobbying and compliance does not generate growth. Investing generates growth. And I'm going to show you a couple of charts now about a regulatory situation. Go to the next. You'll see new federal restrictions. This is measured, I believe it's George Washington University created this index or this metric. Under the Carter administration, you averaged 25,000 new a year. Under Reagan, you averaged 6,200 a year, although none in the first 5 years. Under Bush Sr., 25,000, very similar to the very similar to the Carter, even though it was a Republican. Clinton, even though a Democrat, very similar to Reagan. Down to 6,200, you got higher growth as a result, and in fact was negative regulation. That is, they got rid of more regulations than they introduced in his last term. Bush Jr., much more like Carter, and Bush Sr., quite interventionist, 22,000 regulations a year, and under the Obama administration's 8 years, 17,000. Every one of those was lobbied over. Every one of those had compliance-related issues to them. The smaller the number, the less money sucked into lobbying and compliance. Go to the next. Pages in the Federal Register. Every regulation gets published, has to be digested. The longer it is, the more lobbied over it was, and the harder it is to comply with, is a crude rule of thumb. You'll see the number of pages on average in the Federal Register during each of the presidential terms. Carter was quite interventionist, up in the 75,000 range. Reagan came down to about 50,000. Bush Sr. around 55,000. Clinton around 65,000. Bush Jr. up in the 75,000 range, and Obama, you'll see the dark blue line was at about 82,000, but in 2016, the last year of his administration, it set an all-time record of 96,000 pages. There was a regulatory rush, and it's not surprising that growth diminished in the face of that. The Trump's first year, 2017, came in at about 60,000 pages, of which a large number were in the first quarter, which were spillover publications relating to the end of the Obama administration. On a run rate, they're probably down in the 45,000 page range. And again, just think of fewer pages to lobby about and to comply with. Go to the next. There's another metric, I think it's George Mason University has come up with, is economically significant new regulations per annum. Under Reagan, they only started it with Reagan. Under Reagan, it was about 17 per year. Under Bush Sr., 45. Clinton, about the same. Bush Jr., about the same. And you can see that under the Obama administration, it jumps up to the 62 range. Again, regulation brings about lobbying and compliance rather than investment. There were 3 in 2017 during the Trump years, so far in 2017. So notably lower regulations, notably more incentive to invest rather than comply and lobby. Go to the next. Where are corporations at? If you look at corporate profits in real terms, they're high. They've been plateaued for about 6 years, up and down, but pretty plateaued for about 6 years. Pretty typical that what happens as you move into the good part of a cycle, most of the benefits go to labor rather than to businesses. The benefits of the early part of a cycle go to business. because labor is very abundant. As labor becomes tighter, the benefits go to labor, not to business. And that's why some of the silliness that was published about inequality and so forth was published as this cyclical movement was happening. And since then, it becomes kind of irrelevant. Distributed profits, just think of them as dividends, although they can be private companies as well, buybacks and such. Distributed profits have plateaued at a high level, but they plateaued, and so companies' after-tax profits have plateaued, their distributions are pretty much plateaued, but they're in good shape. Go to the next, private sector employment. Private sector employment, I put the previous cyclical high, marked it with red. We're at an all-time high. We're growing. We're growing at about 2 million employees a year. I think that will continue. I think the tax cuts and the regulatory cuts will generate very good job growth and very good economic growth. I think GDP will grow in excess of 3% the next 2 years. And I think that employment will grow 2 million or more the next 2 years. That's going to feed excesses, and that excess is ultimately what's going to cause the next downturn. But in the meantime, it looks quite good. Go to the next couple of pictures of the labor market will do. You see the unemployment rate very much near an all-time low for the blue, for all workers, down around 4%. It rarely gets much below 4%. It is true there are a lot of people not in the labor force that might traditionally be there, and I think they're going to get lured back as the economy heats up. And you can see the unemployment rate for youth has fallen dramatically. That little jump you see, you can't see that it came right back down the next month here at the end. That was a data anomaly. So the labor market looks good for youth. It looks good for everybody. Go to the next chart, and you'll see weekly unemployment insurance claims. These are real time. These are not survey. I say this every time. This is contemporaneous measure of the labor market and its strength. You see the red as average, and I mark the high and the low in history. And we basically are running very close to an all-time low in terms of people filing for unemployment insurance, even though uninsurance benefits are quite good by historic standards. In addition, if you adjust for the size of the labor force, you go back to 1968, you see it was even lower than it is today, but the labor force was about half the size it is today. So when you do it on an adjusted basis, the labor market is even stronger today than it was back then. So you have a quite robust, and I think that's going to start pushing wages more, not to 10 and 20%, but it's going to push them at 2 to 3% regularly the next couple of years above inflation. That's going to bring some people back into the market. Go to the next chart. I've showed this before. It's particularly noteworthy that the people who are in the labor force like never before are coming into the labor market more than ever before. And as the baby boom ages, it's going to be even higher. I think this could get up into the 30 to 40% range over the next decade as the baby boom ages. The labor force participation rate among those 65 and over bottomed in 1999 and has steadily risen. I think it will continue to steadily rise. Basically, they're healthy. They enjoy working. Surveys show that most of the working over 65 do it because they enjoy the work, they enjoy the social dimensions, they enjoy the challenge. Only about a third say it's because they need the money. Go to the next. Let's take a view of where we're at with real wealth, again, adjusted for inflation, on a per household basis. And what I've done is measure it versus a long-term trend. So if it's above the line, it means it's 2, 3, 5, 10% above trend. If it's below the line, it shows you're below trend. You can see we're above trend by 3 to 5%. Real wealth per household is about 3 to 5% above trend. People are just starting to feel like they've got more money than they thought they would have. That will fuel excesses. On the other hand, if you look at the previous peaks, this is still quite early. And hence, I think as confidence is there, jobs are there, wages grow, I think this will even pick up more. The one group that does not have higher wealth than they did a decade ago is about 1.5 million households that lost their home and did not buy a home. And if you think about it, if you were a poor person, you had no wealth a decade ago, so you had nothing to lose. The very rich had financial assets, and financial assets have recovered. If you were a homeowner all the way through, home values have recovered, so your wealth is recovered. The ones who did not recover are about 1.5 million households who owned a home, lost a home, had no particular financial assets, so they didn't benefit from the financial assets going up, and they didn't benefit from the home values going up. And it messes up the median data because those people are kind of median people. So there is a kind of hollow part in benefited. So basically, out of the 130 million households in the US, if you had to do a quick swipe, you'd say 1.5 million of them are clearly worse off than they were 10 years ago in terms of wealth. Everybody else is the same or better, and I stress the same, namely if I had no wealth, I still have no wealth in many cases. I'm not saying I'm well off, I'm no worse off. So this is just starting to heat up and it will feed economic growth. Go to the next chart. Household debt is a percent of disposable income. I put a red trend line just to help you do what you were going to do with your eye. And what you can see is got way out of whack in the early 2000s. And that was as people were taking on consumer debt, they were taking on home equity loans, and they were taking on mortgages they couldn't support. As that disappeared, people today have a lower debt as a percent of disposable income. Remember, this is debt. In addition to that, the interest rate on this debt is a lot lower than it historically has been. What does this mean? This means that people have capacity. They have capacity to borrow. They have capacity for some interest rate rises and still being able to afford their debt. Go to the next chart. You'll see real consumer debt. And it's broken down into credit cards, auto loans, student loans, and other. This does not include mortgage debt, so-called consumer debt. The most interesting thing is that you can see the auto loans have stayed about the same. They've gone up slightly, but that's because as the population grows, there are a few more autos out there with a few more loans on them. The credit card debt over the last decade has gone down notably in real terms. The student loans have gone up dramatically. And what has really happened is people have swapped short-term, expensive, always coming due credit card debt for consumer loans in the form of long-term interest forbearance periods, student loans. And the other interesting thing about the student loans is that about a quarter of them are in default and nobody's particularly acting to collect on them. So there's this oddity where it really, you wonder, are student loans anywhere near as high as they appear to be because people are behaving as if they don't have them. And if you look at their behavior, there have been studies of the different consumption behaviors of young people with student loans and those without, and interestingly, they don't find much difference in their savings patterns or in their spending patterns. Some are paying their loans and some are not, but it basically says, I'm going to maintain a lifestyle, and if I can't maintain a lifestyle and pay off my loan, I'm not going to pay my loan. And if you listen to what most of us have talked about, we say, gee, well, they have to cut back their lifestyle to service their loan. And the simple answer, at least of the research I've seen, is you got to be kidding. I am not going to change my lifestyle. I'm just going to not pay off my student loans and let them come get me. And the truth is, nobody really comes and gets them. And when they do, there's a very easy forgiveness standard, so they don't destroy their credit record in the process. Go to the next. Treasury yields, you can see the long bond at 10. And by the way, since we made this chart a week ago, you know it's up another 30 basis points from here. On the short end, you can see it's risen. It's still, the short rate, you see how low it is. In that, yes, it's up, but it's still low by any historic standard. If you say inflation's still around 2%, and we have a short rate of 1, you still have a negative short-term interest rate. That says that the short-term rate could rise by another 100 to 150 basis points until you get a positive real rate. And you know that the market rate has to be a positive real rate. It may not be a big positive real rate, but it has to be a positive rate. As a result, these interest rises are simply going to feed the economy's growth by better allocating capital. These low interest rates misallocated capital and were a drag on the economy. And you can see that in the next chart. The next chart shows that basically $2.2 trillion in interest income, adjusting for inflation, interest income, $2.2 trillion in interest payments were taken from savers. And you go, well, those savers would have done something with that money. And in particular, it was taken from savers who saved their money in checking accounts, banking accounts, and 6 months to 2-year CDs. That is to say, real Americans. Real Americans use 6 months, 2-year CDs to invest in, and they use banking accounts and checking accounts. They don't use hedge funds. They don't buy office buildings. They don't use stocks. Therefore, the cut in interest rates took $2.2 trillion out of the pocket of mom and pop America, and in many cases, grandma and grandpa America. They would have used a lot of that money to subsidize the down payments of their children and grandchildren. And one of the big drags on the economy has been the single-family housing market, because people have not had the down payment, and they've not had the down payment because the money has not been there, because the short-term interest rate has been artificially low. And so people say, well, as the interest rate rises, won't it choke off the economy? Not at all. Not until you get above the market rate, which has got to be 25 to 50 basis points above inflation. So you have another 125 basis points the short rate needs to rise before the rate starts getting to where it's hurting the economy by being too high. We're just getting to the right level. Go to the next chart and you can see the multifamily side. The multifamily side has a cumulative gap since 2002 of about 900,000 fewer units than suggested by pure demographics would have been built. And all of it was during the great downturn. Right now, multifamily is being produced at around its historic norm. So we had this huge shortfall. Now, that's not to say every market is underbuilt in multifamily, but as a general statement. Go to the single-family market, you look at the single-family homes, we're still 150, 200,000 units below any kind of historic average, chugging forward but being dragged back by not having enough down payments. Normally, by this point in the cycle, you would have had single-family housing starts not at 900,000 units a year, but more like 1.4 million, 1.5 million. It would be feeding the excess. And if you go to the next chart, you'll see, in fact, that single-family housing starts gap currently is about 2.8 million over the last 16 years. There was an overproduction in the early years. that was more than offset by this massive underproduction. That's the big shortfall. Real quick switch, next chart, to brick retail sales, at least as best I can estimate them in real terms. And real, think of throughput. I put a marker at the previous cyclical high. Brick sales are about the same as they were a decade ago. They had a cyclical downturn. They've recovered. They're about the same. In inflation terms, they're higher, but in real terms, they're about the same. That's interesting because if you look at the next chart and you look at what happened to online sales over that time period, they've skyrocketed, which is to say total retail sales in real terms are up, with basically all of the growth over the last decade going to clicks rather than bricks. Now, as we've talked about in the past, the clicks have a hard time making money. That's a small problem, and they're still growing. But another way of viewing it is that in the last decade, we brought online more retail space. We have the same amount of retail sales. That means we brought on space that was not truly net needed. And I think if you did a quick estimate of the next decade, my quick estimates say, in real terms, you're not going to see brick sales fall. It's just they're going to be relatively flat over time with cyclical ups and downs, but relatively flat in real terms, with most of the growth going to the internet. However, that's a very different picture than saying bricks disappear. Bricks are still around, they're still growing, they're still doing just fine, and they're profitable in contrast to the click sales. Real quick, looking at the next, the age of the typical U.S. automobile back on trend. Why is that important? It got below trend when people refused to buy cars because they were afraid, they didn't have confidence or money. They let their cars get older, and then they've gone on a buying spree, and they brought the age back down. And they brought the age back to about normal. The reason their age grows over time is technological advance. So the auto sector is in pretty good balance right now. Quick look at the next. Let's go to the credit sector. If you look at the credit sector, banks have about $15 trillion of excess lending capacity. They've got about $6.5 trillion of loans, and they've got about $21 trillion of total lending capacity for an excess of 15. Banks have plenty of money to lend from a regulatory point of view. Go to the next chart. If you adjust for inflation and you look at what banks lending looks like, look at commercial real estate mortgages in the red, and you can see, yes, they've rebounded, but they're still below their previous peak, previous cyclical peak. And in fact, they're kind of on trend. Remember, the economy grows, values grow, you add more property over time. And commercial and industrial loans, those are lines of credit if you think about it to businesses. They've rebounded to an all-time high. So banks are lending, they're expanding capacity at about 5 to 6% beyond inflation, and that's because they have tremendous capacity, and I think that continues. If you then ask about real estate values, what I find the biggest determinant of real estate values is over any sustained period of time. It's not interest rates, it's not GDP growth, etc. It is the flow of funds. And there's a lot of funds out there to still flow, both debt and equity. You see the debt very clearly. And the other thing that has a tremendous impact on real estate values is excess construction destroys values. So if you look at the chart that says commercial and industrial construction contracts, the footage is pretty restrained. You see the red is the average, blue markers at high and low. We were chugging along. It looked like we were going to go above average. And then about 18 months ago, banks pulled in their lending for new development. They didn't eliminate it. They reduced their LTVs by about 500 basis points, and that put a governor on the amount of construction. So right now we're constructing around an average amount of square footage in the economy by historic standards. Pretty disciplined. Does that mean there are no markets oversupplied? Of course not. There are some oversupplied, but if I tell you there's an oversupplied, there's also an undersupplied, if the total is about average. So when you look at this, there's a lot of capital to support real estate values. Supply is under pretty good discipline to support real estate values. Go to the next two charts. Let's go to the one that says read implied cap rates for multifamily, a very easy mark-to-mark sector. Cap rate, this is the spread over 10-year Treasury. It's running 220 basis points. I would differentiate that from 2006, 7, and 8. If you go back then, the spread was basically zero. We had the same cap rates, interest rates were higher. Today, there is a risk spread associated with the investment. And it's not a terribly abnormal spread. So you feel some comfort in the pricing, especially given the amount of liquidity. And then if you go to the next chart, I took out retail, regional malls, and shopping centers. The reason I'm showing REITs is you have pure transparency on their pricing. That's all. And if you look at their implied cap rates, over the last year, their implied cap rates, the spread has risen by probably 60 to 80 basis points. I think it's oversold as a sector. Good retail is actually doing quite well. It's hard work, but it's supposed to be hard work. It's not supposed to be easy. And so I think good retail is massively oversold right now. And bad retail, I'm not sure is ever too cheap. And if no one wants to shop there, I'm not sure it's ever a bargain. Let me wrap up, Bruce, with two charts. One are, where do the excesses normally develop for about 2 to 3 years before the end? Single-family housing production. Well, we're underproducing, not overproducing. Multifamily production. We're producing about average and we have a cumulative shortfall. We're not overproducing. Auto. Usually by this point you have a big excess in auto. We don't. It's pretty average right now. Consumer credit. You saw the pickup in consumer credit, and yes, credit cards are picking up, but most of the pickup is in student loans, and as I said, I'm not even sure people view that as debt. Consumer confidence. We're in the early phases of excess, but we're not in the big zone of it. And corporate debt outstanding, where it's picking up. But if you look at corporate debt lending, say on buyout deals, pretty flat at about 6 times EBITDA. Now you may say it's on a cyclically high EBITDA, but it's stayed fairly flat for the last several years. Similarly, if you look at coverage ratio on commercial real estate mortgages, stayed pretty good. I'll end with the Canaries. I do every time. These are some metrics I have. I give 5 living Canaries for each of these metrics. If all the Canaries are dead, the end is here. If probably 10% of the Canaries are still alive, the end is near. We're somewhere around half of the Canaries are dead. Now, if you think about a cycle that's 7 years, going on 8 years or more in length, to only have half the Canaries dead, you still got some distance to go. It will end. We will eventually have even more dead Canaries, but the end does not look like it's here in the immediate. Bruce, with that, let me end and say thank you.
Okay, great, Peter. Thank you so much. I'd just like to take a moment here and just inquire, if you don't mind, telling us how many folks are in the room on your end, the participants, just so we have an idea. That would be wonderful. So thank you for filling that out. And while Peter gets a glass of water, a drink of water, I'll start to look through the questions here. As I said, folks, please feel free to send your questions through the questions pane of the control panel, and we will we will take a look at them and chat about a handful of them. Unfortunately, we're not going to be able to get to all of them. Okay, I'll give another 20 seconds here just to fill out that poll, and then I'll close it down. Thank you for those who have responded so far. Okay, and we've got around 80% voted. So let's just close it off there. That's good enough for government work, as they say. And one of the questions that came in, Peter, is what things are going pretty well, right? So what is there out there that what's in the back of your mind? What keeps you up at night? What's some triggering event that can wipe out a bunch of the canaries?
Excess. What I spend most of my time doing is looking for excess and panic. You saw some degree of panic on the stock market. I don't Twitter a lot or tweet a lot, whichever is the right verb. But when the stock market fell the other day, a week ago, whenever it was, and bounced around, I said, you know, value, stocks may fall and stocks may rise, but value doesn't change very much. And I think, therefore, what I'm looking for is excess and panic. You're not seeing signs of excess yet. And you are seeing a few signs of panic here and there. Having said that, you know, you've seen people willing to step in and buy. It's kind of volatile. It reminds you of, I think what's going to happen in a funny way over the next 2 years is it's going to be like the game of musical chairs. And in the beginning, when there's 10 people playing and 9 chairs, there's not a lot of tension. And every time a chair disappears, the tension level goes up, because there's not proportionally as much to go around. And I think that's kind of the next couple of years. So I'm looking for panic. I've not truly seen panic yet. And I'm looking for excess, and I've not seen them, but that's what I'm monitoring. And by the way, if North Korea shoots nuclear missiles at us, you don't need me to tell you that's not going to be good for the economy.
Great, thank you very much. Yeah, let's hope that doesn't ever happen. Question from the audience: is there merit to the notion that the tax cut at this point in the cycle is pouring fuel on the fire that doesn't necessarily need it?
No, I think that's a very fallacious argument. It was actually kind of a, you know, we've all had the job of coming up with an argument to make. This is almost like a debating team exercise, which is, I'm going to give you that side of the argument of why they shouldn't cut the tax in terms of growth. And you go, really? I can come up with, maybe I'd rather use the money for redistribution. Okay, we got that one. And that one you can make sense of. And then you say, gee, it's pouring fuel on the fire. Come on, it's not pouring any fuel on any fire. This is not about stimulating the economy. This is about letting people have the benefit of their efforts, their investment efforts, their work efforts, and creating more work efforts. I don't want to just create more work opportunities in a downturn. I want more work opportunities all the time. I want better work opportunities all the time. I want people spending their money all the time. So to argue that this is somehow a stimulus, it's not a stimulus. It will stimulate, but that doesn't mean it's a stimulus. This is about an improvement in the incentives to work and invest long term.
Thank you. And so as we look at possible continued interest rate hikes from the Fed, where do you think is the tipping point where when interest rates pass this particular level, it's going to start to really impact real estate values negatively?
On the short end, as you start seeing the short rate get up in the 3 point something range, they're pushing beyond probably where it should be. They'll start choking off economic activity that will dampen demand. On the long end, we've looked at this cap rate history over long periods of time, and we've had high cap rates when interest rates are very low. Think of 2009. We had low cap rates when interest rates were quite high. Think of 2007. We've had everything in between. I just don't think there's that big a correlation over a longer term between interest rates and cap rates. And that's because there's just so many other things happening. So as those interest rates go up, there's a lot of other things happening in the economy, most of them good, that are fueling values.
Great. Thank you. We talked about this topic that I'll comment upon in a second on the last call, where sponsors are having trouble underwriting deals because pricing is so high, especially in the multifamily sector. And I think that the gentleman who asked last time was talking about, suburban Nashville or not a tier one or tier one city. And there's an echo of that here where it says we're a Class C/B value add multifamily buyer nationally, and we've completely stopped looking at broker deals because the pricing is just so thin. Is this a sign of potential recession coming on, potential recession looming, or the alternative, are they just bad underwriters?
No, I don't think they're bad underwriters. I think that they're pretty honest underwriters. Look, you can always find a deal, right? That's separate as a statement. But as a general statement, I think they're probably pretty honest underwriters. Does that mean it's overpriced? No, it's supposed to be hard to make money. It is supposed to be hard to make double-digit returns with reasonable leverage. And we get used to windows where it took courage, but it wasn't hard. The hard part was mustering the courage. The hard part was finding the money. But if you had the courage and you could find the money, it wasn't hard to make double-digit returns. You get used to those periods, and I think history's lesson is it's supposed to be really hard to make double-digit returns. It just is. I include appreciation in that. And there's, even if you have courage, there's no shortage of people with courage and money right now. And it's priced like it's probably supposed to be. And by that I mean it's hard to make money. If you then turn to those same honest underwriters that we're talking about, and I said, with 65% leverage, can you underwrite honestly an 8 to 10% IRR? They'll answer yes. And you say, well, wait, 8 to 10%? That's a pretty good return. If you could give me an 8 to 10% the rest of my life, sign me up, right? And yet they're not doing it because they're used to and seeking 13s to 20s. 13 to 20s are hard to find unless they tend to be periods where courage is scarce and capital is scarce. And this is not a period where courage is scarce or capital is scarce, and therefore it's hard. And I'll use the analogy to the Super Bowl. Do you think it was easy for the Eagles to win. Every play was brutal, right? Every play was brutal. Even though you ended up being the best team, you scratched out a victory. It's supposed to be hard if you're playing at the big leagues. And I think that's the reality. My experience is, can you pro forma on the kind of property you described, 8 to 10% honest IRRs, 8 to 9s with 65% debt? Yeah, you can do it. It's just hard to get 18s.
Thank you. In past webinars, you've made reference to a cohort of folks out there who are basement dwellers, meaning young folks out of college living in their parents' basement. One of the questions out there was, which demographic trends concern you and which surprise you?
Well, interestingly, 2 generations ago, they lived in the cellar. Now, they live in a second-story room that they've had all their life with windows and so forth. So they don't live in basements anymore, Bruce. You're showing your age. What demographic worries me other? Quite frankly, the opioid. And the opioid stuff really is more striking demographically than people realize. The estimates are probably at least 1 million relative to normal, relative to historic normal. About 1 million, mostly young adults, are unable to participate in the labor force primarily because of opioid-related issues. That's a staggering number. We only have 143 million people working, so you're talking about a lot of people beyond what normally might be incapacitated. And I'll put a second highlight under that. Those of you who may remember, I think 2 seminars over the growth in life expectancy, and it grows at about 7 weeks a year for the last 100 years, essentially. Well, the last 2 years, life expectancy has basically been flat to gone down. And it's all being driven by 18 to 24-year-olds dying from opioid beyond normal, beyond historic norm. So you've got probably almost 40,000 young people, and those are resources lost forever. So imagine a person who would be a quite productive person. If they can just weather the storm, they'll have a long and productive life. They will have a life that may have a tough year or 2 in it, but it will end up being a life of 80 or 90 years productive. But if they die, we've lost that human capital forever. And we're losing 40 to 50,000 a year that we'll lose forever. It's almost, that's the kind of number we lost in the whole Vietnam War. And in fact, if you look at the Linneman letter, I think the last issue, I put it compared to some war deaths. That, just like the young people who die in wars never come back to be productive, these opioid deaths are sort of our self-imposed generational war that's wiping out resources, both in the contemporary sense and in the longer-term human capital sense.
Okay, great. Unfortunately, thank you to everyone who did send questions, and we're not going to be able to get to all of the questions. Just as a heads up, though, this webinar is really just a digest of what is presented each quarter in much more detail in the Linneman letter, which is a hard copy subscription produced by Linneman Associates. And more information on that can be found on the LinnemanAssociates.com website. Also on the website are a free 50-part audio interview series with Peter and I on the real estate business and capital markets, and video interview series that Peter did with BizNow Media. And again, the website address is LinnemanAssociates.com. Thank you again for everybody who joined today and participated and we hope to see you back next quarter.